The gap just narrowed, concerned, and that should worry you more than when it was wide. For weeks, the story in this market was the spread between what Shanghai was paying for physical silver and what New York's COMEX screen was showing. At its widest, in December 2025, buyers on the Shanghai Gold Exchange were paying more than $8 per ounce above the COMEX futures price. In January, when silver briefly touched an all-time high of 121.62, that spread approached 10%. A premium so large and persistent that arbitrageurs around the world should theoretically have been buying silver in New York and shipping it east until the gap closed. They didn't. Not at scale. Not enough to matter. And now, as of this week, spot prices have pulled back into the mid to upper 80s after a violent Iran war-related spike and a 13% two-day crash. COMEX sits around $88.80 in near-month futures this morning. The Shanghai benchmark is sitting roughly $180 below that, around $87. On paper, the gap has nearly closed. Some outlets are reporting that as normalization, as calm returning. It isn't calm, it's compression before the next expansion. And here's the math that should make your brain pause before we go any further. As of February 27th, the first notice day for the March 2026 COMEX silver contract, 10,226 contracts were standing for physical delivery. Each contract is 5,000 ounces. That is 52.63 million ounces of silver that buyers are demanding be handed to them in physical bars. The total registered inventory in COMEX-approved vaults on that date was 86.13 million ounces. Do the arithmetic. 52.63 million divided by 86.13 million. More than 61% of all the silver COMEX has declared available for delivery has been claimed in the current contract month, in a single delivery cycle. That is the highest percentage in modern exchange history, according to public CME Group data. The question this video is going to answer for you is not whether the gap between Shanghai and New York is closing. The real question is why it's closing, and what that answer tells you about where both prices are going from here. By the time we're done, you'll understand the mechanism behind the premium narrowing, you'll know what 3 specific numbers to watch in the next 72 hours, and you'll understand why what looks like a quiet consolidation on your price screen today is structurally anything but. Start with what the London Bullion Market Association, the body that sets global standards for wholesale precious metals trading, has been signaling through its lease rate data. Silver lease rates, the cost of borrowing physical silver in the interbank market, spiked to between 24% and 35% on a one-month basis in late 2025 and into early 2026. To put that in historical context, silver lease rates in a normal market trade around 0.35% to 0.70%. The surge to 24% and then 35% represents not a gradual rise but a systemic stress event in the physical lending market. What lease rates at that level mean in plain language is this. The parties who need to borrow physical silver for immediate delivery are now willing to pay an annualized rate of over 24 percentage points to get it. That does not happen when there is enough metal available. That happens when the pipeline is nearly empty. By the time March's delivery season began, COMEX registered silver stocks had fallen to 86.13 million ounces. That number needs a reference point to mean anything. In April 2020, registered COMEX silver sat at 240 million ounces. In 6 years, 153.87 million ounces of deliverable silver has left those vaults, a 64.1% decline. And during the first week of January 2026 alone, the CME Group's own vault reports showed 33.45 million ounces were physically withdrawn in just 7 days. That single week represented 26% of what was then registered inventory, gone. These are not paper transactions, these are warranted 1,000-ounce bars physically leaving approved warehouses, with ownership transferring to parties who want possession of the metal itself. The Shanghai Gold Exchange tells a parallel story from the other direction. SGE silver warehouse inventories, which had been 559 tons in November 2025, had fallen to 318.5 tons by February 2026, a 43% decline in 3 months. Both the Eastern Physical Exchange and the Western Futures Exchange are seeing the same phenomenon, physical silver moving out of the system faster than it moves in. When inventories fall simultaneously in 2 geographically opposite storage systems, the shortage is not regional, it is structural. Here is the piece of this story that most financial media covering the Shanghai premium ignored entirely. When the SGE was trading silver at $8 or more above COMEX in December 2025, the rational trade seemed obvious. Buy in New York, ship east, collect the spread. The reason that trade did not close the gap is documented in import cost data. Physically moving silver from COMEX to Shanghai involves import duties and VAT that total between 13% and 24% of the metal's value. At current price levels, that means the cost to import 1 ounce of silver into China from a Western vault is somewhere between $11 and $20 per ounce on top of the purchase price. the arbitrage that everyone assumed would automatically equalize the markets cannot function under those friction costs. The gap can persist, and it has. That structural barrier, not manipulation, not irrational behavior, but actual import economics, is what kept the premium alive for months. Now we need to talk about why the premium is narrowing today specifically, and why that narrowing does not mean what the surface reading suggests. Silver's spot price spiked to above $96 per ounce on March 1st and March 2 of this week, driven by what is now one of the most significant geopolitical events in the modern Middle East: the U.S.-Israel military operation against Iran, the reported death of Ayatollah Ali Khamenei, and the brief closure of the Strait of Hormuz. Safe haven demand flooded into precious metals, and silver, which had already broken above the 90-91 resistance zone in late February, briefly tested levels that had analysts reconsidering triple-digit territory. Within 48 hours, silver crashed more than 13%, falling to 83.70 on March 3rd. That kind of reversal is not irrational. Silver has a dual identity that gold does not carry. It is a monetary metal and simultaneously an industrial metal with enormous exposure to global manufacturing demand. When war fears spike, the safe haven buying rushes in. When recession fears follow, because war disrupts supply chains and suppresses manufacturing output, the industrial demand component gets repriced simultaneously. The exits are narrower and the drops are steeper. That 13% crash erased the entirety of the geopolitical premium that built up on Iran news. Silver is now consolidating in the mid to upper 80s. COMEX near-month futures sit around 88.80 this morning. The Shanghai benchmark has pulled back proportionally to around 80 centiminars, so the gap, which was $8 or more at its widest, is now under $2. And here is the turn in this story, the thing that changes the meaning of a narrowing gap entirely. In December and January, the Shanghai premium was driven by China paying up aggressively for physical metal, while Western paper markets were still in the process of adjusting to the reality of scarce inventory. China was pulling metal east, and New York was slow to catch up. That is one mechanism for a premium to narrow. Shanghai stops pulling so aggressively, and COMEX catches up to where Asia already priced the metal. But there is a second mechanism for a premium to narrow, and that second mechanism is the one that is operating right now. When both prices fall simultaneously, when the paper market in New York drops sharply on margin liquidation and forced selling, and physical markets in Shanghai fall with it because speculative capital exits globally. The gap between them can compress not because the physical market is relaxing, but because the paper market is dragging the physical price down with it temporarily. The metal in those vaults did not appear. The structural deficit, 148.9 million ounces in 2024 alone, and a cumulative 678 million ounces across the 4 years from 2021 through 2025, according to Silver Institute data, did not resolve itself in a week of price volatility. The physical reality is unchanged. What changed is the paper price. You can print contracts. You cannot print the metal itself. That sentence matters, because the March 2026 delivery cycle is demonstrating it in real time. The 10,526 contracts standing for delivery as of first notice day represent 52.63 million ounces of silver that buyers have decided they are not rolling, not settling in cash, but taking as physical bars, against 86.13 million ounces of registered inventory. That leaves roughly 33.5 million ounces of buffer before registered stocks are effectively depleted by this delivery cycle alone. And those 86.13 million ounces are not all necessarily available in a practical sense. A significant portion of registered silver may be encumbered, committed to prior agreements, pledged as collateral, or held by parties who have registered it but have no intention of releasing it into the delivery pipeline. The headline inventory number is the maximum. The practical available supply is lower, and nobody outside the individual vault operators knows exactly how much lower. What is documented publicly in CME filings is that February 2026 was the highest volume delivery month in modern COMEX silver history. 5,036 contracts representing 25.18 million ounces were physically delivered. Not rolled, not cash settled, delivered. The highest February delivery volume on record, and now March is demanding 52.63 million ounces on the very first day of the delivery period. The historical parallel that maps most closely to this structure is not the Hunt Brothers episode of 1980, though that gets cited most often. The more instructive parallel is the London Metal Exchange nickel crisis of March 2022. In that event, short sellers in nickel futures, primarily a large Chinese nickel producer, found themselves caught by a rapid price spike that made their short positions catastrophically expensive to cover. The LME, facing a situation where the price discovery mechanism was at risk, halted nickel trading entirely, canceled a day's worth of trades retroactively, and introduced daily price move limits. The LME nickel halt was not a random market event. It was the outcome of a paper market that had accumulated commitments it could not satisfy under real-world conditions. The difference between 2022 nickel and 2026 silver is not structural. It is scale. Nickel's crisis was concentrated in one actor's position. Silver's current condition involves the Silver Institute's documented years of structural supply deficits, industrial demand from solar manufacturing, electronics, and AI-linked hardware that has surged 51% from electrical and electronics applications alone since 2016, and a COMEX delivery mechanism now processing volumes it has never sustained before. If anything, today's silver situation is more diffuse and more systemic than the nickel squeeze, which is why it is less visible to casual observers. There is no single villain. The math is the villain. The strongest version of the counterargument deserves to be stated honestly, because dismissing it would be intellectually dishonest and would ultimately serve no one watching this video. The bearish case goes like this. Silver surged 154% in 2025, hitting $121.62 at its peak in January. It has since pulled back substantially, trading in the 80s. That pullback is precisely what you would expect after a parabolic move driven by speculative excess. The March delivery demand, while high, has been managed without a formal exchange default. The CME has already introduced margin hikes and cash-settled alternatives to relieve pressure. The Federal Reserve is expected to hold rates at its March 18th meeting, which limits further safe haven urgency from rate cuts. And the DXY, the US dollar index, has been weakening on the back of a disappointing February payrolls report, which normally supports metals, but a weak economy is also a headwind for industrial demand, which is silver's largest demand component. On that read, the current price consolidation is healthy digestion of an overcrowded trade, and the Shanghai premium narrowing reflects a return to rationality, not a prelude to further disruption. That case has real merit. This market can stay suppressed longer than the data alone would predict. The CME has demonstrated it will raise margins and introduce cash alternatives when delivery stress becomes acute. PSLV's announcement in January that it doubled its at-the-market equity program to $2 billion, meaning it is prepared to acquire approximately 18 million ounces of additional physical silver at current prices, tells you something about institutional conviction on the physical side. But SLV, the iShares Silver Trust administered by BlackRock, has seen outflows of approximately $1.4 billion over the past month, while PSLV and physically backed alternatives have attracted inflows. That divergence suggests the more sophisticated institutional capital is distinguishing between types of silver exposure, favoring vehicles with direct physical backing over paper-proximate ETF structures. That is not a bearish signal. That is a rotation toward metal over contracts. Here is what to watch specifically over the next 72 hours. First, CME Group publishes its daily vault report at approximately 6 p.m. Eastern each trading day. Tonight's report will show the current state of March delivery progress, how many of the 52.63 million ounces demanded have been transferred, how many are still outstanding, and whether registered inventory has continued declining or stabilized. If registered stocks fall below 70 million ounces before the delivery cycle completes, the buffer between outstanding demand and available supply enters territory that has no recent historical precedent to resolve comfortably. Second, watch the Shanghai Gold Exchange's daily benchmark price and its relationship to COMEX near-month futures. If the SGE benchmark, which has compressed to within approximately $1.80 of COMEX, begins widening again while COMEX prices remain flat or decline, it signals that Asian physical demand is reasserting itself against the paper pullback rather than following it lower. Premium widening during a Western price consolidation is structurally significant. It means the physical market is starting to disagree with the paper market again. Third, the Federal Reserve's March 18th meeting is 8 days away. The CME FedWatch tool currently shows broad consensus for a hold. But the language in the statement, specifically whether the Fed signals any increased concern about stagflation from oil prices that briefly approached $100 per barrel on Hormuz closure fears, and it will affect real rates. Falling real rates are historically among the most reliable conditions for silver's monetary premium to reassert itself over its industrial discount. None of this is guaranteed. I want to be clear about that. The market can and does behave in ways that temporarily defy structural data. Margin hikes can liquidate leveraged long positions overnight. A Strait of Hormuz reopening can collapse geopolitical premiums in hours, as we saw in the 13% crash last week. A further deterioration in global manufacturing data can suppress industrial silver demand faster than physical investment demand can compensate. This market has already shown you in January that it can move 40% in a month and then give a substantial portion of that back. Anyone telling you the outcome of the March delivery cycle is predetermined is not reading the data. They are selling you certainty that does not exist. What the data does tell you, clearly, calmly, and without requiring any speculative leap, is this. The global silver market has now recorded 4 consecutive years of structural supply deficits totaling 678 million ounces. Annual mine production cannot cover annual industrial consumption plus investment demand at current levels. That gap must be filled each year by above-ground stocks, bars and coins held in private vaults, ETF holdings, exchange inventories. Those sources are finite and measurable. COMEX registered inventory has fallen 64.1% in 6 years. SGE inventories fell 43% in 3 months alone. LBMA lease rates have spiked to levels that have not been seen in the modern era of the silver market. These are not forecasts. They are recorded facts, published in public filings and exchange reports. The COMEX Shanghai spread narrowing that you see on your screen today is real. The compression is real, but the conditions that created the spread in the first place have not resolved. The structural deficit is not smaller because silver's price fell 13% in 2 days. The 52.63 million ounces of March delivery demand is not smaller because the COMEX screen price pulled back. The mechanism that created the premium is still operating. The question is whether the paper price will hold its ground long enough to force the physical reality to re-express itself through the futures market, or whether the physical market will simply continue rooting around the Western futures system entirely, with industrial buyers signing direct offtake agreements with miners, with institutions moving assets into physically allocated vaults rather than ETF shares, with Asian exchanges building price discovery capacity that doesn't depend on COMEX registered inventory at all. That last scenario is not theoretical. Electronics manufacturers and solar panel producers have already begun signing long-term offtake agreements directly with primary silver producers, according to reporting from multiple metals market analysts covering the March delivery period. The era of just-in-time industrial silver purchasing from exchange warehouses may not be ending this month, but the signal from industrial buyers who are no longer willing to depend on that system is one of the most structurally meaningful shifts in how this commodity moves through the supply chain. The screen price is the last thing to adjust. It always is. Physical markets move first. Lease rates spike first, inventories fall first, offtake agreements get signed first, and eventually the futures market reconciles with the reality that everyone in the physical chain already priced weeks or months earlier. Given that March's registered COMEX inventory is now processing more than 61% of its delivery obligations into a single contract month, the highest ratio in exchange history, and given that the Shanghai Gold Exchange benchmark is currently trading below COMEX futures for the first time in months, here's a specific question I want you to think about and put in the comments below. If tonight's CME Vault report shows registered silver stocks continuing to fall during the active delivery period, at what level do you think the CME will introduce the next round of emergency margin increases? And do you think that will compress the COMEX Shanghai gap by cooling paper demand, or widen it by forcing physical demand to root entirely outside the exchange system? Drop your number and your reasoning below. The most analytically precise responses from this week will be pinned. The May COMEX silver contract becomes the front month as March deliveries complete. I'll have the analysis of where registered inventory lands after this cycle and what the May open interest structure looks like the night before those numbers are published. Subscribe and turn on notifications if you want to see that analysis before market open. It's the data point that will set the tone for the next leg of this trade. Everything in this video is sourced from public data. CME Group's daily vault reports and delivery notices, the Silver Institute's published deficit figures, the London Bullion Market Association's lease rate disclosures, the Shanghai Gold Exchange's daily benchmark prices, ETF flow data from iShares and Sprott, and public market reporting from the week of March 2nd through March 10th, 2026. All of it is linked in the description. I'm not a financial advisor, and nothing here is investment advice. These are the numbers. Verify them yourself. The links are there. Make your own decisions.